how USD liquidity, FX stress, and yields set the trap. Roughly once a cycle, markets get handed a headline that looks like a scandal but behaves like a schedule, a Friday dump, a late week air pocket, a sudden liquidation that seems emotional until you realize it's mechanical. Here's the shocking claim, and I want it to land with the weight it deserves. What you're watching is not panic. It's the dollar system rebalancing itself by force, and it does it most efficiently when liquidity thins and weekend risk is priced like a weapon. The public narrative will be China dumped, stocks crashed, yields spiked, gold popped, silver whipsawed. The real narrative is simpler and colder. The USD funding matrix is the world's margin account, and when the largest holders of dollar claims and dollar liabilities move at the same time, the adjustment is non-negotiable. Recent estimates put daily global FX turnover around the mid-single-digit trillions, roughly $6 to $7 trillion a day depending on the survey. That number matters because it tells you what kind of machine you're dealing with, a market so large that no single actor controls it, yet so tightly coupled to collateral, swaps, and sovereign funding that a small kink in liquidity can spill into everything. And here's the inevitability statement people don't want to hear. The pattern is mathematical. When the cost of dollars rises faster than the system's ability to create high-quality collateral, the unwind is not a question of if, it's a question of where, who, and how violently. The reason Friday matters is not superstition, it's settlement, it's balance sheets, it's risk managers. It's the fact that the global dollar machine runs on continuous rollover, repo, FX swaps, commercial paper, bank credit lines, derivatives margin, and the weekend is the one period where time itself becomes an additional constraint. If you're short dollars, you can't negotiate with Saturday. If you're levered long risk assets funded with cheap short-term liabilities, you can't refinance a margin call with a motivational speech. Friday is the point where the system chooses between carrying risk for 2 days of news risk and uncertain liquidity, or dumping it into the market and letting prices do the work. That's why the dumps cluster there. Not because everyone suddenly becomes emotional on Fridays, but because the plumbing becomes less forgiving. Now, let's define the mechanism, because you can't understand the event until you understand the sequence that produces it. Every major monetary regime blow-up, every sudden market air pocket, every unexplainable FX shock follows a fixed chronology. First comes a setup phase, a stable-looking foundation built on a rule, a peg, an implicit backstop, or a political promise. The setup feels safe precisely because it hides fragility behind credibility. Then comes expansion. Credit grows, liabilities accumulate, and the currency's purchasing power is implicitly sacrificed to keep the system running, sometimes through overt money creation, sometimes through fiscal dominance, sometimes through the quieter route of negative real rates and financial repression. After expansion comes the crisis phase, the part people remember. The moment the market stops believing the story, yields move, FX breaks, or the central bank is forced to choose between saving the currency and saving the balance sheet. And finally, the inevitable outcome. The system either resets the currency's value, restructures the liabilities, or devalues in real terms through inflation, default, or a control disorder that feels temporary until it becomes permanent. That's the mechanism. It's not ideology, it's arithmetic. Setup creates the conditions. Expansion leverages the conditions. Crisis reveals the conditions. Outcome reprices the conditions. If you want proof, don't look at theories. Look at case studies where the sequence is written in dates, decisions, and market prices. Let's start with the most famous modern reset of the dollar system, the Nixon shock of 1971 and the stagflationary 1970s that followed. This is not a history lesson, it's a blueprint. The setup phase began after World War II with Bretton Woods. The world was offered a clean bargain. Currencies were pegged to the dollar. The dollar was convertible to gold at $35 an ounce. Stability would be purchased with discipline. The US had the gold, the industry, the geopolitical leverage, and the credibility. For a while it worked, but stability always tempts expansion. And expansion arrived through the very success of the system. As global trade grew, the world demanded more dollars to settle transactions and hold reserves. Those dollars had to come from somewhere, and they came from US deficits, fiscal and external. This is where the math starts tightening. The more dollars the world holds, the less believable the promise of gold convertibility becomes, because the gold stock doesn't scale with the liabilities. By the late 1960s and early 1970s, the expansion phase was in full view. Vietnam War spending, Great Society programs, and growing U.S. balance of payments deficit meant dollars were leaving the U.S. and accumulating abroad. Foreign central banks and institutions held swelling dollar claims, while the U.S. gold stock was not expanding in parallel. This is a classic overextension, a currency promise backed by a finite asset against an expanding liability base. The market sensed it. Countries began to question the convertibility pledge. The London Gold Pool, a coordinated effort to stabilize gold prices, had already broken down in 1968 under pressure. The system was straining, and the strain showed up where it always shows up first, in the relationship between the currency and the hard asset that anchors trust. Then came the crisis, Austat, loss of control moment. In August 1971, President Nixon suspended the convertibility of the dollar into gold for foreign official holders. That's the Nixon shock. It wasn't simply a political decision, it was the inevitable choice at the end of the setup and expansion math. The U.S. could either defend the gold peg by tightening policy and shrinking the dollar base, inviting recession, unemployment, and political pain, or it could break the promise and preserve domestic flexibility. It chose flexibility. That's what loss of control looks like in real time. The rule that anchored expectations is removed because it cannot survive the accumulated liabilities. And then the outcome phase arrived, not as a one-day event, but as a decade-long repricing. With the gold anchor gone, the dollar's value became a function of policy credibility and inflation outcomes. The 1970s delivered stagflation, high inflation with weak growth, because the expansionary impulse didn't disappear, it intensified. Oil shocks played a role, but the deeper point is monetary. Once a regime signals that convertibility or discipline is optional, inflation becomes the path of least resistance for managing debt burdens and social promises. Bond investors learn this lesson the hard way. They demand higher yields to compensate for inflation risk, and yields rising are not just a market quote. They are a tightening no politician can vote against. The bond market becomes the enforcer. Here's the crucial mapping to the mechanism. Bretton Woods was the setup. Deficit-driven dollar issuance was the expansion. Suspension of convertibility was the crisis moment. And the inflationary repricing and yield regime shift was the outcome. And now, connect it to your screen. In every phase, the market crash is not a random tantrum. It is the price mechanism forcing balance sheet reality into public view. Notice something else. Precious metals were not a sideshow. Gold became the referendum. Once the currency's anchor was cut, gold's price became the expression of what the system refused to say out loud. Gold surged throughout the 1970s, reflecting declining trust in paper claims. Silver followed with even more volatility, because silver is both monetary metal and industrial input, and that duality turns stress into whiplash. In inflationary or credibility crisis periods, paper promises are questioned and physical demand becomes the signal. Premiums rise, delivery matters, inventories tighten, and the difference between a quoted futures price and the cost to obtain actual metal becomes a story of its own. The market learns to distinguish between price and availability. Now take a second case study, this time a currency regime that tried to look modern, credible, and permanent until the moment it wasn't. The United Kingdom's exit from the exchange rate mechanism in 1992. Remembered as Black Wednesday. This is where you see, with brutal clarity, how FX stress and bond yields form a pincer that can break a policy promise in days. The setup phase here was political and monetary. The UK joined the ERM in 1990, committing to keep the pound within a defined band against the Deutsche Mark. The goal was credibility, importing Germany's anti-inflation reputation by linking sterling to a stronger currency. The setup always sounds noble: stability, discipline, convergence. But the fragility is embedded in the promise. A peg or band is not merely an exchange rate, it's a commitment to align your interest rates and economic conditions with another country's, regardless of your domestic cycle. That's the seed of future stress. Then came expansion over extension. The UK entered the ERM at an exchange rate that many argued was too strong for its economic conditions. The early 1990s saw recessionary pressures, high unemployment, and a housing market strain after the late 1980s boom. Yet, to defend the pound within the ERM band, the Bank of England had to keep rates high relative to what domestic conditions wanted. High rates are not just a macro variable, they are a cash flow constraint. They squeeze borrowers, raise the cost of capital, and weaken growth. Meanwhile, speculators and investors watch the fundamentals diverge from the policy promise. They calculate coldly that defending the band will require either even higher rates or massive reserve depletion, or both. This is where the crisis phase arrives. The moment the market tests the promise, in September 1992, selling pressure on the pound intensified. The UK attempted to defend sterling by spending reserves and hiking interest rates, dramatically, because that's the standard defense. Make holding the currency attractive by raising rates and use reserves to buy it. But this is exactly the mechanism's choke point. If the market believes the defense is politically or economically unsustainable, raising rates becomes gasoline on a recessionary fire. It signals desperation. The more you hike, the more you damage domestic conditions, and the more you confirm that the peg is incompatible with reality. Bond yields and funding conditions tighten, volatility jumps, and the market's incentive to attack grows because the payoff becomes asymmetric. If the peg breaks, the currency drops, and those who shorted it win big. If it holds, they risk limited loss against a central bank that is constrained by politics and growth. The outcome phase on Black Wednesday was swift and definitive. The UK withdrew from the ERM and let the pound float. Sterling devalued. The promise was gone. And once again, the reset was not a moral failure. It was the arithmetic of maintaining an exchange rate commitment against fundamentals and political limits. The peg was the setup, the misalignment and high rate constraint was the expansion and overextension, the speculative attack and emergency rate hikes were the crisis, and the exit devaluation was the outcome. Now, take the lesson and apply it to the broader system you're living inside. The global dollar regime is not a peg in the narrow sense, but it functions like a peg for the world's balance sheets. Corporations, banks, sovereigns, and commodity producers hold dollar liabilities because dollars are the settlement currency, the collateral language, the pricing unit. That creates a global short dollar position in many forms: debt service, trade finance, hedging costs, derivative margin. In good times, expansion feels effortless. In tightening times, the world discovers it has written promises in a currency it does not control. This is where the Friday dump becomes intelligible. It is the symptom of a system that has moved deep into the expansion phase again, an era of enormous debt issuance, fiscal deficits, and a market structure that relies on constant refinancing and abundant collateral. When the system transitions from dollars are cheap and available to dollars are expensive and scarce, you don't get gentle adjustments. You get discontinuities. You get air pockets in liquidity. You get bid-ask spreads widening in the most liquid markets. You get U.S. Treasury yields jumping not because investors suddenly became philosophical, but because dealers' balance sheets and funding markets are tightening simultaneously. You get volatility rising because volatility is the price of uncertainty in a leveraged structure. And in that environment, China sold is often a shorthand for something more technical and more dangerous. Large reserve managers and large global participants adjusting duration, collateral, and FX hedges in a way that transmits instantly through the Treasury market, the dollar index, and risk assets. When a major holder sells Treasuries, it's not just a supply event, it's a collateral event. Treasuries are the backbone of Repo. They are the preferred collateral for margin. They are the asset that turns into cash with minimal haircut, until it doesn't. If yields spike and haircuts rise, the same Treasury that was risk-free becomes a funding constraint. Suddenly, everyone who levered through Repo feels it. Funding rates rise, basis trades wobble, and the market starts liquidating what it can, not what it wants. Think about how a weekend amplifies that. A large sale into Friday does three things at once. It pressures prices when liquidity is thinning. It forces dealers to warehouse risk or demand concessions, and it raises the probability of margin calls that must be met immediately. Equities, credit, and commodities don't crash because they deserve to. They crash because they are the most convenient source of liquidity. The system sells what has bids, and it sells what can settle. That's how a dollar shortage expresses itself, in the forced liquidation of everything priced in dollars. Now layer in inflation, deflation transmission. When the dollar strengthens, global financial conditions tighten. Emerging markets with dollar debt feel the squeeze first. Commodity prices often soften in local terms or move violently as hedging costs change. Global trade slows at the margin, which is deflationary in demand terms, even as domestic services inflation might remain sticky. That's the nightmare mix: tighter liquidity and higher funding costs, alongside stubborn price pressures. The bond market then becomes the battleground. If inflation prints stay elevated, yields want to rise. If growth cracks, yields want to fall. But if the Treasury market is also absorbing heavy supply through auctions and financing, that supply through constrained dealer balance sheets, yields can rise even in a slowing economy, because term premium and funding stress override the textbook narrative. And that's where precious metals enter, not as a trade, but as a stress valve. Gold sits at the intersection of currency credibility and real rates. When real yields rise, gold can get hit, until the market decides those yields are not sustainable or are being driven by funding stress rather than genuine growth. Then gold behaves like a referendum again. Silver, meanwhile, becomes the amplifier. It trades like a monetary metal on the way up and like an industrial metal on the way down, which means it can be punished in a deflationary impulse and then explode when monetary credibility becomes the focus. That's why you see vicious swings. The paper market reprices instantly, while the physical market tells the slower truth through premiums, delivery delays, and inventory drawdowns. This is not abstract. In tight conditions, futures markets can show one price, while coin shops, refiners, and wholesale bars show another reality. Widening spreads, higher premiums, longer delivery times. That divergence is the difference between financial liquidity and physical availability. Paper silver and paper gold can be sold in size in milliseconds. Physical metal must be mined, refined, shipped, and delivered. When stress rises, the desire to hold no counterparty risk instruments rises too. You see it in the way inventories at exchanges can draw down, in the way registered deliverable stocks become a watched number, in the way lease rates and forward curves can shift when metal is being pulled into private hands. The system can quote a price. It cannot quote trust. Now, bring it back to the mechanism we defined, because this is where most people get lost. They watch the tape and think the tape is the story. The tape is the symptom. The story is the sequence. The setup today is the post-crisis architecture, a world conditioned to believe that the dollar backstop is infinite, that central banks can always calm volatility, that treasuries will always be absorbed, that liquidity can always be injected faster than panic can spread. The expansion has been years of debt accumulation, suppressed volatility, carry trades, and balance sheets built on the assumption that refinancing will remain cheap. The crisis phase begins when that assumption fails, when FX basis widens, when funding markets tighten, when auctions show weak demand or require higher yields, when the cost of hedging dollars rises for foreign holders, when volatility makes leverage unworkable. And the outcome phase is the reset, either a repricing of assets, a repricing of the currency's purchasing power, or a forced policy pivot that chooses which part of the system will be sacrificed. The Friday dump is the moment the crisis phase becomes visible. It's the moment the market stops pretending the setup is stable and starts charging the true price of dollars, of duration, of risk. You can call it a geopolitical act. You can call it a vendetta. You can call it a warning shot. But if you ignore the plumbing, USD liquidity, FX hedging costs, Treasury supply and dealer balance sheets, repo conditions, and the volatility feedback loop, you will misunderstand the move and you'll be positioned exactly where the system wants liquidity to be harvested, in the crowded trades that look safe until they become exits. Two historical regimes just prove the point. Bretton Woods showed what happens when a credible anchor cannot survive expanding liabilities. Black Wednesday showed what happens when a currency commitment cannot survive misaligned fundamentals and political limits under speculative pressure. In both cases, the crisis wasn't emotional. It was arithmetic catching up. The only thing that changes from era to era is the instrument through which the arithmetic expresses itself: gold convertibility, FX bands, yields, or the dollar funding basis. And that brings us to the uncomfortable question that must be answered next, because it determines whether this is a one-off shock or the opening move of a larger reset. If the dollar system is tightening into the weekend, and if large holders are adjusting duration and FX exposure at the same time, the Treasury market is asked to absorb heavy supply, where does the stress go first? Into yields, into equities, into the dollar itself, or into the paper versus physical fault line in gold and silver? The answer is not philosophical. It's in the daily mechanics of auctions, swaps, repo, and delivery. And that's where the present-day application starts. Volatility cascades, inflation transmission, and why gold and silver become the exit valve. The answer is in the plumbing, and plumbing has dates. Before we apply the mechanism to the present, you need the third proof point, the one that shows how quickly a stable monetary story collapses once the funding constraint bites and the political promise meets market arithmetic. This case is not ancient. It's modern enough that the details sound familiar, and that's precisely why it matters. The Asian financial crisis of 1997 to 1998, beginning with Thailand's baht and spreading across currencies, yields, and balance sheets like a contagion that was really just the dollar system enforcing margin rules. The setup phase looked like a development miracle. Throughout the early 1990s, several Asian economies ran managed exchange rates, de facto pegs or tight bands, often oriented to the US dollar. Capital flowed in, credit expanded, and foreign currency borrowing became the shortcut to growth. Banks and corporates borrowed in dollars because dollar rates looked cheaper, and because the peg made the FX risk feel theoretical. It wasn't theoretical, it was only hidden. The system was built on a promise. The currency would remain stable, and if it wobbled, the central bank would defend it. Then came expansion and overextension, and the overextension was textbook: short-term external liabilities, maturity mismatches, leverage, and an asset boom financed by foreign capital. Thailand is the clean example. By the mid-1990s, credit growth and real estate excess collided with a widening current account deficit. Reserves were being spent defending the peg as the market sniffed out the mismatch. The more capital flowed in, the more the system could pretend it was stable. The more it borrowed in dollars, the more it became structurally short dollars. That is the trap. You can't borrow in a currency you can't print and call it cheap funding. You can only call it borrowed time. The crisis phase arrived when the market called the bluff. In 1997, Thailand burned reserves to defend the baht, used forward positions, and signaled strength, while the underlying arithmetic worsened. On July 2, 1997, Thailand abandoned the peg and floated the baht. That moment was not a local accident. It was the first domino revealing the global mechanism. Once the peg breaks, the local currency falls. Once the local currency falls, dollar liabilities explode in local terms. Once dollar liabilities explode, borrowers scramble for dollars. Once everyone scrambles for dollars, the dollar strengthens and spreads the squeeze to the next balance sheet. That's how it propagated. The Indonesian rupiah collapsed. The Korean won came under extreme pressure. IMF programs followed. Domestic rates spiked as countries tried to defend currencies or stabilize financial systems. Corporate defaults surged because the debt was in dollars and the revenues were in local currency. The crisis was not confidence. It was the arithmetic of FX mismatch and dollar scarcity. Then the inevitable outcome, a forced reset through devaluation, restructurings, austerity, and political change. The promise of stable FX was replaced by the reality of floating currencies and scarred credit systems. The mechanism mapped perfectly. The peg and growth narrative was the setup. Dollar borrowing and leverage was the expansion. The peg break and reserve depletion was the crisis. And the devaluation default reset cycle was the outcome. And notice the recurring villain. Not a country, not a leader, not a speculator, but the global shortage of dollars when everyone needs them at once. Now we apply the mechanism to today, step by step, with the cold precision the market itself uses. Not vibes, not ideology, mechanism. The setup today is the modern dollar system, a world where the USD is still the primary invoicing currency for trade, the dominant reserve asset, the core collateral for global funding, and the settlement language for derivatives. That means the dollar system is not a concept. It is a daily rollover of liabilities and hedges. Foreign holders own treasuries not just for yield, but because treasuries are collateral. Corporates and sovereigns issue dollar debt because global capital prefers dollar claims. Banks intermediate that structure through repo, FX swaps, and derivatives margining. The system looks stable when rollovers are cheap and predictable. Check. Then the expansion phase. Years of debt accumulation and duration supply layered on top of leverage that only works when volatility is low and funding is abundant. The expansion isn't only about government deficits. It's also about how the private system built strategies on stable correlations. Carry trades across FX, risk parity allocations that assume bonds hedge equities, basis trades that assume treasuries can be funded reliably in repo, vol target funds that assume volatility, mean reverts. All of that is leverage wearing different outfits. It's still leverage, and leverage always has the same weakness. It cannot survive a sustained rise in funding costs and volatility at the same time. Verified. Now the crisis trigger in the present system is almost always the same. The marginal price of dollars rises. Sometimes it shows up as a stronger dollar index. Sometimes it shows up as a wider cross-currency basis where non-US institutions must pay up in FX swaps to obtain dollars. Sometimes it shows up as repo stress, rates printing above the policy corridor or collateral becoming special. Sometimes it shows up as swap spreads moving in a way that screams balance sheet constraint, not macro optimism. The public sees yields up. The insider sees collateral scarce and balance sheet full. Undeniable. Here's how the Friday dump fits into that chain. When large reserve managers or large institutions reduce treasury exposure or adjust duration into thin liquidity, the immediate effect is not just price, it's the cost of financing that price. Treasuries are supposed to be the world's clean collateral, but when supply is heavy and dealer balance sheets are constrained, the market demands compensation. Term premium rises, real yields rise, swap spreads can compress or behave erratically as dealers ration balance sheet and hedge flows. Bid-ask spreads widen in what people still call the most liquid market on earth. And that phrase becomes a joke you only laugh at once. Check. Watch the auctions. In a tightening phase, the Treasury market stops being a passive sponge and starts being an active stress test. Weakness shows up in tails, auctions pricing at higher yields than expected, and in indirect bidder behavior, and in the way bid-to-cover ratios change as the marginal buyer demands yield. The details matter because they reveal who is absorbing supply and at what price. If primary dealers are forced to take down more than they want, they must finance it. Financing means repo. Repo means collateral terms. Collateral terms mean haircuts and balance sheet usage. That's how an auction turns into an equity sell-off 3 hours later. It's not magic. It's forced balance sheet optimization, verified. Now overlaid debt rollovers. The US has a massive stock of debt that must be refinanced continuously. Corporates have maturity walls. Sovereigns everywhere are rolling debt at higher rates than the last cycle. When policy rates are high, the rollover cost is a direct fiscal drag. If inflation is sticky, the central bank can't cut easily. If growth slows, tax receipts weaken. You get fiscal stress without a headline crisis, until the market demands a higher term premium. That's when yields rise, not because the economy is booming, but because the system is asking for more compensation to hold long-duration paper in an environment where inflation, uncertainty, and supply are both high. Undeniable. Now comes the liquidity cycle that makes the Friday dump feel like a trap. Liquidity is not money in the system in some abstract sense. It is the ability to transact size without moving price, and the ability to fund positions without being forced to liquidate. When repo is smooth, basis trades flourish. The classic basis trade, buying cash treasuries and shorting futures to pick up the spread, looks like free money until financing rates jump or haircuts rise or volatility increases and margin calls arrive. Then the trade becomes a liquidation engine. If enough players run similar positions, the unwind becomes self-reinforcing. Sell cash bonds, buy back futures. Spreads blow out, yields gap, risk assets get sold to meet margin. This is how a bond thing becomes an everything thing. Check. FX stress then transmits the shock globally. When the dollar tightens, emerging market currencies face pressure. Developed market currencies with large external deficits feel the squeeze. Corporates with dollar liabilities rush to hedge or refinance. The hedging cost itself becomes the story. Cross-currency basis widens, meaning foreign institutions pay a premium to swap their currency into dollars. That premium is a hidden rate hike. It tightens financial conditions without a central bank press conference. It forces selling of foreign assets to raise dollars. It pressures local bond markets as investors demand higher yields for currency risk. The same dynamic that crushed balance sheets in 1997 repeats in a modernized form. Dollar scarcity becomes everyone's problem. Verified. Now the inflation-deflation dynamic turns ugly because the system can deliver both at the same time in different channels. A stronger dollar and tighter global financial conditions are deflationary for global demand and often for commodity complexes. But domestic inflation can stay sticky through wages, rents and services, and through fiscal pass-through. That creates the worst backdrop for both stocks and bonds. Equities dislike slowing liquidity and slowing growth. Bonds dislike inflation, uncertainty, and heavy supply. Correlations flip. Volatility rises. Risk models break. When vol rises, vol targeting and risk parity reduce exposure mechanically. That selling adds to the selling. The market is not deciding. It is executing risk rules under stress. Undeniable. Now we arrive at precious metals, and this is where the public narrative gets the most wrong. Gold and silver are not just inflation hedges, they are system hedges. Gold responds to real yields, yes, but also to credibility and to the perceived path of policy under constraint. When real yields rise because the market is pricing genuine disinflation with tight policy, gold can struggle. When real yields rise because the market is pricing term premium and funding stress, gold can initially wobble and then catch a bid as investors realize the system is tightening in a way that risks an accident. Gold is the hedge against policy losing control of the path. Check. Silver is the stress valve with a hair trigger. Because it has monetary and industrial demand, it behaves like a lie detector for the cycle. In a liquidity squeeze, silver can drop hard as risk assets are liquidated and industrial demand expectations weaken. Then, when the market shifts from growth scare to currency credibility and policy constraint, silver can rip higher with violent speed. That's where supply-demand mechanics matter. Paper silver trades on leverage. The futures market can reflect liquidation in minutes. Physical silver, however, lives in bars, coins, industrial inventories, and refinery capacity. When demand for physical rises, either from investors or industrial users trying to secure input, premiums can jump even if paper prices are soft. Delivery becomes the constraint, not the quote. Verified. This is where you watch inventories and delivery mechanics. Exchange inventories can draw down as metal is pulled from the system, and the market starts watching not just total stocks, but deliverable stocks. The metal that can actually be delivered against contracts. If registered inventory tightens, if lease rates rise, if backwardation flickers, those are signals of stress in the availability layer. And you can see the fault line between paper claims and physical reality and premiums. Coins and small bars trading at elevated premiums, wholesale bars tightening, delivery times extending, and the spread between spot, futures, and retail widening. This divergence is the market's way of telling you the same message FX and repo are telling you. Trust is being repriced. Undeniable. Gold has its own version of that story. Central bank buying, sovereign reserve strategy shifts, and private demand can pull metal into long-term hands. When that happens, the floating supply available to satisfy marginal paper selling can be thinner than the screen implies. Again, the quote is not the whole truth. The quote is the marginal transaction in a leveraged marketplace. Physical flows are slower, but they are more honest. When a system enters the crisis phase, honest flows matter. Check. Now stitch the steps together and the Friday dump stops being a mystery. A late week sell-off is a timing choice inside the crisis phase. Push risk into a thinner window, force repricing, trigger margin, and VAR constraints, and let the weekend amplify uncertainty so the market opens Monday already repositioned. Meanwhile, the real machine keeps running. Auctions, funding, hedges, collateral, basis. If the dollar is tightening, if term premium is rising, if swap spreads are signaling balance sheet constraint, if repo is noisy, if FX basis is widening, the system is not stable. It is transitioning. And transitions in leveraged systems are always violent because leverage turns gradual changes into discontinuities. Verified. So, what do you do with this, practically, without becoming the liquidity exit? You stop thinking in headlines and start thinking in indicators that reveal the plumbing. Watch the dollar's behavior against stressed currencies, not just the broad index. Watch cross-currency basis if you can access it, because it tells you the true cost of dollars offshore. Watch Treasury auction quality, tails, bid to cover, dealer takedowns, because that is where supply meets real money. Watch term premium and real yields because they tell you whether the bond market is tightening conditions, even if policy pauses. Watch repo conditions and signs of collateral scarcity, because that's where safe assets can become funding constraints. Watch swap spreads and credit spreads, because they show you whether the system is pricing balance sheet risk. Watch volatility itself, because volatility is the tax that forces de-risking. Undeniable. Then treat gold and silver like gauges, not slogans. If paper prices are falling but physical premiums are rising and inventories are drawing down, the market is telling you stress is migrating from screens to supply chains. If gold holds up despite rising yields, the market is telling you yields are rising for the wrong reasons. Term premium, funding stress, credibility risk, not because growth is roaring. If silver whipsaws, don't mock it, respect it. Silver is the metal that reveals when liquidity is dominant versus when trust is dominant. In a crisis phase, the dominant force can change quickly. Check. And now the warning you don't get to ignore, because it is the only honest conclusion of the mechanism and the case studies. This time is not different. American exceptionalism is not a force field against arithmetic. Tech will save us is not a monetary policy. Modern optimism is not collateral. These are stories people tell themselves when the setup feels permanent and the expansion feels painless. But every case study you've seen, from Bretton Woods to Black Wednesday to 1997, ends the same way once funding tightens and promises meet the market's math. The only choice is how the outcome is paid, through inflation, through deflationary liquidation, through financial repression, through currency repricing, or through some combination that will be sold as a temporary patch. The discipline is simple and brutal. Don't be over-levered into the weekend in a tightening liquidity regime. Don't assume correlations will save you. And don't let the screen price convince you the underlying system is fine. Track the plumbing. Respect the auctions. Respect the dollar's funding pulse. Keep an eye on where stress is migrating. FX, rates, credit, equities, metals. And recognize that when the system needs liquidity, it will take it from the most crowded places first. If you want to survive this cycle, you have to stop being surprised by the mechanism and start anticipating it. And if you want the next layer, the part most people never learn until they're forced to, then follow the build of the machine itself. How the dollar collateral stack was engineered, why the basis trade became a hidden pillar, and how the next stage hits when the market finally refuses to warehouse duration at any price. Because once you can see the machine, you can stop being its exit liquidity. The verdict is calm because the math is calm. Liquidity tightens, funding costs rise, FX stress transmits, yields reprice, volatility cascades, and gold and silver reveal where trust is escaping. If you can track those steps, you can stay ahead of the trap instead of inside it. When the next Friday dump hits, will you be watching the headline or the plumbing?